Gubbi is now joining us. He's co-founder at Marcellus Investment Managers. Pramod, great to have you with us here on the channel. It's been a while. Prashant this side. Pramod, what's your sense? I mean, it's pretty clear now. There is no accommodation by the governor's own admission. It's about taming inflation. The only question is whether in the August meeting it's going to be 25 or 50. And of course, what's the final terminal rate, etc., going to be? What does it mean for equities, though? Your sense?
Hi, Prashant. Thanks for having me. Good to be back. Yeah, I mean, I don't think it is a surprise if the August policy also sees a 25 to 50 bips hike, because that's really the RBI's mandate, right, to pull back inflation into that range of 4 plus or minus 2%. So we still have some way to go before it comes in that. But I would not second guess the direction beyond that, because there's lots of moving parts behind this inflationary situation. Yes, in the West, particularly in the US, the demand has been in an overheated zone thanks to the big stimulus. But there have been other supply side issues as well, which some of them seem to be abating. Clearly, the lockdown in China had exacerbated the situation. Now that China is opening up, hopefully some supply of goods coming back should help the supply side situation. But of course, the war-related commodity price inflation, I don't think we have any answers on the anvil. But I think there's also an element of wealth effect feeding into the jobs market in the US. If you see further correction in asset markets, you will see further participation in the labor market, which should also bring down wage inflation. So I wouldn't see too much into this, given how many variables around that. Impact on the stock markets is what you asked. We've always maintained that the stock markets in the short term are nobody's game to predict. We'll tend to stay out of it. But having said that, I think the movement in the recent weeks or so are providing good opportunities for investors, particularly for those with longer term horizons. We've always recommended to be more of a consistent investor, continuously deploying their savings at every level. As long as you're convinced that the businesses that you're investing are significantly well positioned to face these headwinds, and also are priced at levels which are significantly below their intrinsic value. So we continue to be buyers in the market of our chosen portfolio stocks, irrespective of the short-term headwinds.
Right. We take your point there, Pramod, and I'm sure this is a question that would have come to you multiple times over the last 10 days or so, which is with regards to one of your portfolio themes, so to say. It is the paints theme, and there was a disruption by virtue of a player, announcing a large capex there, Grasim wanting to be the number 2 player in paints. What does that do to your thesis of consistent compounding in something like an Asian Paints or Berger Paints?
Sure. Look, in some ways, it actually reinforces the attractiveness of the business, right? So many new entrants coming in demonstrates that there is money to be made in this business. I don't think people would enter a loss-making business or an industry with very weak dynamics. So to that extent, it sort of reinforces how attractive the paints business is. Having said that, we've owned paints simply because it provides significant barriers to entry. When I say barriers to entry, it's not just simply about setting up a plant. It's the ability of new entrants to take significant market share from the incumbents. And mind you, this is not the first time we've seen new entry into the paints industry. There have been several new entrants over the last 2-3 decades, and yet some of the incumbents have continued to gain market share. Having said that, I don't think we should take it lightly as well. We are always concerned about the moves by some of the new entrants. It is hard, but it is not impossible to disrupt here. Hopefully, the nature of the new entrants means that you won't see any sort of irrational moves in terms of pricing. Even if you did that, it's simply not based on pricing, because paints is a voluminous product, and it does offer significant scope for efficiencies through supply chain, where you deliver significantly high inventory turns across the value chain, whether for the manufacturer or for the retailer, which is underpinned by lots of data-driven, demand prediction analytics. which takes time for any new entrant to build. But we are watchful. We are looking at what the new entrants would do. Mind you, the first capacities of the new entrant is likely to come further out, 24 months hence. So it's going to be a while we actually see this sort of reflect in the numbers, if it does. But for now, we see this correction in the paint stocks as an opportunity to top up, given that we don't see any change in the fundamentals. These are businesses with extremely strong pricing power. Yes, raw material price increases have affected margins in the short run, but this is not the first time they're seeing raw material price increases. History demonstrates that they've managed to pull back their gross margins by implementing price hikes, passing on prices to their customers. And also raw material prices eventually, mean revert. They are commodities for a reason. When they'll happen is anybody's guess. But like I said, if you are a long-term investor with the stomach to hold on to these corrections or see these corrections and not panic, this is as good a time to look at these businesses.
Pramod, the Marcellus's criteria in terms of picking stocks, long track record, very highly consistent, profitable growth, I mean, high return ratios. So the framework is there. I'm just trying to understand, with markets having come off and, just the fact that sheer valuations in many areas, pockets, maybe one-offs have come off quite a bit. Have you added to the portfolio, new stocks, apart from adding on to what you already own? And where would those be, if you have?
Yeah, our portfolio remains largely stable, but there are always new opportunities that we're working on, irrespective of the pricing, because the sort of businesses we tend to look at have really long growth runways. So very rarely do companies get overpriced here, provided you have the conviction that these companies will be able to sustain their competitive advantages over decades on an end. But having said that, we have made changes. For example, in our financials portfolio, we've added Home First, the mortgage financier, which we believe has significant moats in terms of data-driven risk management, which again plays into a very long growth runway of affordable housing, and it's significantly heavily capitalized in terms of capital adequacy ratio, which provides cushion in the short run, even if interest rates were to go up, cost of borrowing were to go up. These sort of things give them the cushion to fight these headwinds. But otherwise, the portfolio has been largely stable. But within the portfolio, we are trying to benefit from these sort of jerky price movements where stocks have fallen 10, 15, 20%. We are adding to those stocks and delivering some sort of rebalancing alpha where certain other portfolio stocks might not have fallen as much relative to their fundamentals. Those which have fallen provide that much more of an attractive point. So we rebalance in the portfolios by buying more that have fallen with no changes in fundamentals. So that's the way we are taking advantage of the market movement.
All right, take that point, Pramod. Always a pleasure speaking with you. Thank you for reinforcing, the faith that you have in the paint space, your consistent compounders. At the same time, talking about, adding Home First.